So we're talking now about your FS audit. So for FS audit, generally, it starts with the preconditions of the audit. Preconditions of the audit. So what are these preconditions of the audit? Normally, this happens during pre-engagement activities. So in the preconditions of the audit, we look for three items. The first item is the competency and the capability of the auditor. So whether we are competent to conduct the audit and whether we have enough manpower to conduct the audit. So we check on the competency and capability. Next, we check for independence. So for independence, we look whether we are independent, in fact, and of course in mind, so that the auditor could accept the engagement. And then lastly, we look into the integrity of the client. So under pre-engagement activities, normally we call this one preconditions of the audit. We check for competency and capability, independence, and the integrity of the client. And then we do risk assessment procedures. We do the risk assessment procedures. So for risk assessment procedures, we assess different risks. We assess the different risks. So based on the assessment of the risk, we look into the scope, timing, and the direction of our audit. Scope, timing, and direction of audit. At the same time, the nature, timing, and extent of our audit procedures. Nature, timing, and extent of our audit procedures. And based on these risk assessment procedures, because here we identify the risk, right? We now respond we now respond to the risk. Okay? We now respond to the risk. So there are two responses on the risk, either control reliance or substantive approach. In control reliance, we say that the control is working effectively. Control is working effectively. Thus, control risk is low. In substantive approach, we say that control is not working effectively, then control risk is high. So since this is substantive approach, it means that your detection risk should be low. When detection risk is low, meaning more substantive tests. More substantive tests. And then last, we now complete the audit. So in completing the audit, we now express an opinion. And then we now document and communicate. So that's how our audit goes. We start first by preconditions of the audit. We look into the competency and capability of the firm or the auditor, the independence and the integrity of the client. Then we do risk assessment process. We identify the risk to determine the nature, timing, and extent of our audit or the scope, timing, and direction of our audit. And then we respond to the risk or audit response. Your audit response can either be control reliance or substantive approach. Under control reliance, we say that the control is working effectively. So meaning you test the control here. So there's TOC plus substantive test. In your substantive approach, meaning you don't rely on your TOC, you don't rely on your control, so not much TOC, purely substantive test. So dito, less substantive test lang. So substantive approach, more substantive tests. And then lastly, we complete our audit by expressing an opinion and we document and communicate, of course, the results of our audit. So let's look first as to the approach on our audit. First, there is a management assertion, and you already know what is an assertion. These are representations by management, explicit or otherwise, that are embodied in the FS. So the assertion generally is the FS, that it is properly evaluated and measured. And then we perform audit procedures. This refers to the acts or method used to gather necessarily not all evidence about the validity of the FS assertions to report the audit opinion on the fairness of the financial statements. So that generally, our audit procedures are either TOCs or substantive tests. And then we document our audit audit evidence, and then we create our audit report. By the way, whenever we talk about substantive tests, it is composed of tests of details, and then we have also your analytical procedures, tests of details or analytical procedures. And whenever we talk about tests of details, you either test the details of balances or test the detail of transactions. So we test the detail of balances if ever there are numerous transactions or voluminous transactions in a particular item. So for example, cash, you better test the balance itself. Rather, you test all the transactions. But let's say you are testing shareholders' equity. Then you test the detail of transaction because you have less transactions in a shareholder equity. So pag voluminous yung transaction, normally we test just the balance, the ending balance, whether the balance is correct or not based on our materiality threshold. And then for our transactions, kung kakaunti yung transactions, then you can test all the transactions. Example dyan, property, plant, and equipment, yung mga non-recurring. So pag recurring yung transaction, AR, sales, cash, mga ganon, we use test of details of balances. But non-recurring, PPE, mga ganon, test of details of transactions. And then we can also use analytical procedures as part of our substantive tests. So that is your approach on your audit. Parang kanina, yung whole process, ito, hinati natin from the assertion, we do our audit procedures, we obtain audit evidence so that we can provide an audit report. Now, let's look into your management assertions. So there are two types of assertion. We have your internal control assertion and your FS assertion. So under internal control assertion, management, being responsible for the internal procedures it establishes, has an implied assertion that the internal control are effective in both their design and operation. And under FS assertion, the financial statements so prepared by management are a collection of both the state of affairs of the entity at financial reporting date and the results of its operations then ended. So state of affairs, generally, you know that as your statement of financial position. Operations, your statement of financial performance or income statement. So your internal control assertion, to test that, we have your test of controls. Your FS assertion, to test that, we use your substantive test. So what are the categories of your FS assertion? So we have assertions about transactions and events. We have your COCA. Assertions about presentation and disclosure. We have your COCA. And then assertions about account balances and period end. We have your SERV. And then your FS assertion can be at financial statement level or account balance or class of transaction level. So on your FS level, that the FS as a whole are presented fairly. And then for account balance, that the account balance or transactions are free from material misstatement. So our main responsibility is that the FS as a whole is not materially misstated, or the balance is not materially misstated, or the transactions are not materially misstatement. Therefore, your responsibility is to consider the relevant assertions based on these particular levels. So we look into potential misstatements, the risk of material misstatements, and we perform our audit procedures. And whenever we say audit procedures, again, that is either TOC or your substantive test. So generally, we said that the FS as a whole should not be materially misstated. So, di ba, we have here your transactions. The transactions make up the account balance. The different account balance make up your financial statement. And these three items should not be materially misstated. Should not be materially misstated. And to determine whether it is not materially misstated, we perform our audit procedures. So our audit procedures, either test of controls or we have your substantive test. And we consider the relevant assertions in testing whether these items are not materially misstated. So either transactions and events, presentation and disclosure, and account balances at the period end. So first, transactions and events. So we have here COCAP, we have completeness, occurrence, classification, accuracy, and cutoff. Presentation and disclosure, we have here your completeness, occurrence and rights and obligations, classification and understandability, accuracy and valuation. And then we have your account balances, we have your completeness, existence, rights and obligations, valuation, and allocation. So first, we have your COCA. So under COCA, first, completeness. All transactions and events should have been recorded, have been recorded. So in short, what we need here is just whether all items are complete. All transactions and events are complete. Next, we have occurrence, that the transaction or event really occurred and it pertained to the entity. And then we also have classification, that the particular transaction event was properly classified or accounted for. And then accuracy, whether the particular transaction or event as to amounts are accurately recorded. So the amounts are accurately recorded. And then cut off, whether the transaction or event was properly recorded in the proper time frame. So whether it is this year or whether it is for the next period. Next, for presentation and disclosure, we have COCA, completeness. So here we talk about that all disclosures should have been included in the financial statements have been properly included. Next, we have occurrence and rights and obligations, that the disclosed events, transactions, and other matters have occurred and pertain to the entity. And then we have classification and understandability, that financial information is appropriately presented and described, and disclosures are clearly expressed. We also have accuracy and valuation, that the informations are disclosed fairly and at appropriate amounts. So, as we said earlier, normally we test transactions and we test balances. And then, depending on the transactions, there are different assertions. So they say that since we only test purely transactions and balances, we merge the other assertions or categories of assertions to the other categories, such that your presentation and disclosure is deemed included in your transactions and account balances. So these transactions and balances, we deem include the presentation and disclosure assumption or assertion. However, for the different questions on the board exam, they still use the old assertion category. But since again we're testing either transaction or balances, so assertion should pertain only to transactions and balances. And presentation and disclosure is deemed included on your transactions and balances. But for the sake of board exams and for the sake of the questions normally test, banks are still old, we still discuss P and D disclosure. Next, we have account balances. We have completeness, that all assets, liabilities, and equity interest should have been recorded. Existence, assets, liabilities, and equity exist. Rights and obligations, assets as to rights, liabilities as to obligations, and then we have valuation and allocation of assets, liabilities, and equity. What can you determine, how will you determine the assertion here, whether P&E or account balances? If it's purely already the ending balances of the asset, liability, and equity, the assertion pertain to account balances. If it is purely the event per se, the assertion is about transaction and events. As earlier stated, we said, based on the assertion, based on the assertion, we consider the relevant assertion based on what we will test. So whether FS level or transaction level assertion. So if ever we are testing balances, then we look into the balances assertion. If we're testing transactions and events, then we use transactions and events assertion. So audit procedures. So audit procedures are tied up with your audit objectives. So what is an audit objective? An audit objective refers to the conceptual basis for determining the nature and extent of the auditing procedures necessary to satisfy the audit standards and to verify the basic assertions of management and degree of entities' compliance with internal control. And generally, your audit objectives depend whether it is an FS assertion or internal control assertion. For FS assertion, we have substantive audit objectives. Why? Because we do substantive tests. For IC assertion, we have compliance audit objective. We call this one your compliance or control reliance approach. Okay, so let's look into the different bullet points here. The general audit objectives remain the same for every audit engagement, but the evidence varies depending on the circumstance. The general audit objectives are applicable to every account balance on the financial statements. And after general objectives, we look into the specific objectives for each account balance. And take note, there must be one specific audit objective for each relevant general audit objective. So you will understand this better when we go to your TOC and substantive test. Just remember the concept. For an audit objective, you tie it to your audit procedure. So we need to determine our audit objective, and based on that, we tie it on our audit procedure. Now, whenever we talk about audit procedure, you always hear the term nature, timing, and extent. What do we mean by nature, timing, and extent? First, nature of audit procedure. It refers to the purpose and the type of the audit procedure. Again, it refers to the purpose or the type of audit procedure. So mostly, this includes your trifecta. So your inquiry, ganon, your inspection, so observation, IOI, inquiry, observation, and inspection. So those are the different types of audit procedure. It could be also tracing. It could be also performance, vouching, etc. So nature of audit procedure talks about the type of audit procedure. And it depends on the purpose. So when we say purpose, are you doing it during the planning stage, or doing it during testing stage, or doing it on your completion stage? So depending on the stage of the audit process, we have different types of audit procedures to be done. Next, we have timing of audit procedure, whether it is performed at interim or year-end. So interim, if ever, done during or before year-end, of course, and year-end at year-end. And then we have your extent of audit procedure, whether it is more extensive or less extensive. It being more extensive or less extensive depends on our audit risk and the relationship of our risk of material misstatement to our detection risk. We said if your risk of material misstatement is high, then your detection risk is low. If your detection risk is low, it means that you will have more extensive audit procedures. If your risk of material misstatement is low, then detection risk is high, then you have less extensive audit procedures. Now, your audit procedures as to whether the nature and the timing, depending on the purpose of your testing and the type, the timing, whether it is interim or year end. So that is the relationship of your NTE of audit. So again, we look into our ROMM, we look into our detection risks, whether we have more extensive or less extensive, and based on the extensiveness of our audit procedure, we determine the purpose when we will when we will conduct that audit and the type of our audit procedure. So audit procedures as to nature, I told you earlier, during planning stage, during testing stage. So first, a risk assessment procedure. Under risk assessment procedure, this is designed to obtain understanding over its entity and its environment, including its internal control, to assess the risk of material misstatement at the financial statement and assertion level. So we said here, we identify the risk. And based on the risk identified, we respond to the risk. And how do we respond to the risk? Either tests of controls or substantive tests. Tests of controls for controls reliance, while if you have purely substantive approach, then it is substantive tests. So under risk assessment procedure, we just understand the entity and its environment. For test of control, you test now the compliance over the controls. And then we have your substantive test. This is to detect material misstatement at the assertion level. And we say assertion level, this is either financial statement level or transactions and balances level. And then you already know we can test the transactions, we can test the balances, as long as the financial statement as a whole is not materially misstated. And whenever we talk about substantive tests, I told you earlier, we have tests of details and we have analytical procedures. And under tests of details, we have balances or transactions. So first, tests of details. Test of details involves examinations of items or details that comprise account balance or class of transactions. So if you test the balance itself, we call that test of details of balances. If you test all the transactions, we test of details of transactions. And you want to know the relationship over the items, we can also use analytical procedures. So if you want to look into the relationship of items, analytical procedures, so we identify significant fluctuations or differences on your relationships. So for example, you said that the sales is high. Therefore, it means that it could be that the AR is also high or our cash receipt is high because sale is tied up to your AR and cash. So you look into the possible relationships, and if ever something is wrong out of those relationships, then we do further audit investigation. So that is audit procedure as to nature. Now, let's look into our audit procedure as type. So as to type, I told you earlier, these are the different types of audit procedure. It could be IOI, your trifecta, inquiry, observation, or inspection. Sir, why is it called trifecta? Because whatever is the purpose of the audit, whatever is the purpose of the audit, you always use this IOI. Especially in test of controls, it's purely IOI. So yeah, in whatever nature you have your IOI, that is your type. So other types, aside from inquiry, observation, and inspection, we have also your vouching and we have your tracing. This is a very important type of audit procedure. In your vouching, it involves the existence or occurrence of recorded transactions by following a transaction back to supporting documents from a subsequent processing step. Again, it involves establishing the existence or occurrence of recorded transactions by following a transaction back to supporting documents. So meaning, records, you look into the documents. So generally, the assertion here is existence. How about in tracing? You look whether the documents is in the records. So this is more about completeness. Whether the documents are placed in the records, the assertion there is completeness. Whether the records are evidenced by a document, then the assertion there is existence. And the audit procedure there is known as vouching. Here it's known as tracing. We also have your confirmation. This talks about inquiry as to the balances. Normally, you confirm your AR, you confirm the ending balance of cash for bank balances. You also compute the amounts. You can perform a particular activity. You can also reconcile and do analytical procedures. But what I want you to remember here is the audit trifecta. Why is it audit trifecta again? Because in whatever purpose, whatever stage you do that particular type of audit, and then vouching and tracing. Now, let's talk about audit evidence. So for audit evidence, these are the consideration of the auditor in the planning and performing of the engagement, the nature, timing, and extent of evidence gathering procedures. So earlier, we talked about quantity, quality, materiality, assurance, engagement risk, cost benefit consideration, and professional skepticism. So depending on the risk, again, we have your audit evidence. And we already discussed that earlier when we discussed your assurance engagements. Now, your audit report. So at the end of the audit, the auditor shall form an opinion on the FS through a written report. So the written report is, of course, through an audit report. So what are the audit reports? So the following are the types of audit report. First, we have unqualified. Next, we have qualified. Next, we have adverse. And then we have a disclaimer. First, on your unqualified. So for unqualified, FS are prepared in all material respects in accordance with the applicable financial reporting framework. So prepared in all material respects in accordance. So fairly, give true and fair view. For qualified, financial statements are presented fairly except for. Therefore, you will always see except for in qualified audit report. Next, in your adverse, the financial statements do not present fairly. So do not present fairly, adverse, disclaimer. You did not know if the FS are presented fairly. So in short, either you did not, there's no enough evidence or there is a scope limitation. Therefore, you cannot provide an opinion. So you do not know. Since you do not know, you do not provide an opinion. So we do not express an opinion or a conclusion. So first, let's look into the differences. If the financial statements are misstated, it is material but not pervasive. It is purely qualified. If it's material and pervasive, it is adverse. First, what is material? Material depends on the threshold in your audit, and materiality is based on whether a particular item or amount could influence a decision maker in its particular decision. And as the pervasive, we look into the effect. Okay? We look into the effect. So generally, we look into whether the for FS, we have your different balances. And then we also have your disclosure. Okay. This makes up your financial statement. Now, how can we say that the balance is pervasive, or when can we say that the disclosure is pervasive? So we say that the balances is pervasive if ever it is confined to different accounts, elements, or items. So if ever many accounts elements or items are affected, then the balance is considered the effect is pervasive. But if less than that or not confined to small accounts, then or small accounts or some accounts, then it is not pervasive. As to disclosure, if ever it is fundamental to users' understanding of the FS, it is considered pervasive. Okay, again, for balances or items of the FS, if not confined to specific elements, then pervasive. If confined, then not pervasive. As to disclosures, if ever fundamental to users' understanding, that is the omitted disclosure, then pervasive. If not, not pervasive. Next, as to scope limitation. If the scope limitation is not pervasive, it is qualified. If pervasive, it is disclaimer of opinion. Now, if the limitation is due to management imposed limitation, then you can still resign, especially if that is early on of the engagement. But if you already finished the engagement, then properly provide a disclaimer of an opinion. So I just provided here already the different types of audit report for us to properly understand the whole concept of an audit. So earlier we said we started with the three conditions of the audit. We check that, and then we do risk assessment. We respond to those accessories, either test of controls or substantive tests. And then finally, we evaluate and conclude. Now, in completing the audit, we evaluate by forming an opinion. So now, we look into the different types of an audit opinion and what is the difference on them. So we said if the financial statements are misstated, that could only be qualified or adverse. Why? For qualified, except for an item, meaning there is a material error. However, except for a particular item, then that's qualified. Kasi nga, except for, meaning not pervasive. It is confined only. It is confined. If it's not confined, meaning andito na siya, it is already pervasive. So all in all, the financial statements is materially misstated as a whole. That's why we say it is adverse. Now, as a scope limitation, if not pervasive again, meaning except for a scope limitation on this one, then qualified. Again, it is confined on one item, qualified. If not so confined, then disclaimer of opinion. So you cannot already create your audit, you cannot do your audit, therefore you do not express an opinion. That is disclaimer. Take note, whenever the effect is not pervasive, it is qualified. Whether FS misstated or scope limitation, not pervasive, qualified. Once it is pervasive, for misstatement, adverse. For limitation, disclaimer. Sir, can there be a misstatement that is adverse? There can be a pervasive misstatement that is disclaimer. No, because you cannot say that there is a misstatement in disclaimer. Take note, under disclaimer, you were unable to complete your audit. You were unable to do your audit. Since you're unable to do your audit, you cannot say whether the FS is misstated or not. Therefore, once the misstatement is pervasive, it is always adverse. Scope limitation pervasive, that is disclaimer. Take note, once it is confined, not pervasive, except for qualified. Magbabago na lang yan sa adverse at disclaimer depending on the issue, whether it is misstated or whether there's a scope limitation. Last item on this slide or PowerPoint, concepts underlying financial statement audit. First, independence. We said earlier that we check the independence of the auditor as a precondition of audit. So that is either independence in mind or independence in appearance or in fact. We also have your professional skepticism that the auditor shall plan and perform an audit with an attitude of professional skepticism. So this is more of a questioning mind. And then the auditor shall comply with all PSAs relevant to the audit. This is compliance with the PSAs. So When can we say that the PSA is relevant to the audit? When the PSA is in effect and the circumstances addressed the PSA exists. So long as the PSA or the standard is effective, in short, it is relevant to the audit. And always remember, you need to place a statement of compliance with the PSAs in your audit. Therefore, you must always comply with the audit. So aside from the whole process of our FS audit, always remember, you must have an independence, you have a questioning mind, and you must comply with the audit.